You know that classic image of a bank run, right? People in old-timey clothes, all panicked, lining up down the block. Well, what if I told you that today, that same panic can unfold in a matter of hours? All it takes is a group chat or a few viral posts. That's exactly what we're going to dive into.
And this isn't some hypothetical scenario. Just back in 2023, we saw it happen with Silicon Valley Bank. It was the biggest single-day bank run in U.S. history. And get this, there were no lines around the block. It all happened digitally, at the speed of social media. It's a wake-up call, really, about just how fast things can unravel in our hyper-connected world.
So it begs the question, right? What really goes down when a bank fails? And maybe even more importantly, what can we learn from it to protect our own money? That's the mission today. We're going to peel back the layers here. Look at the big picture, sure, but also what it means for you and me. The goal is to walk away with some real, practical lessons. All right, so let's get into it. First things first, we need to understand what a banking crisis even is, because it's not always that dramatic movie scene of people banging on the bank doors. Nope, there's another kind, a quieter, almost invisible version that can be just as destructive.
So researchers over at MIT have broken this down into two main types. You've got your panic crisis. That's the one we all picture, the classic bank run. But then there's something they call the quiet crisis, and this one's sneaky. There's no customer panic. Instead, the bank's assets, the loans it's made, start going bad. The bank gets nervous and just stops lending money. This creates what's called a credit crunch, and that can seriously hurt the entire economy. So the big takeaway here, a crisis doesn't need screaming headlines to do major damage.
Now, one of the key ingredients that makes these things so explosive is a little something called leverage. Think of it like this. Let's say you buy an asset for 100 grand, but you only put down 10 grand of your own cash. The other 90 grand is borrowed. Now, if the value of that asset drops by just 10%, down to $90,000, poof, your entire $10,000 investment is completely wiped out. That's leverage. It magnifies your gains for sure, but man, it also magnifies your losses.
Okay, so we've got the mechanics down, but we can't forget the human element in all this. At the end of the day, markets are just people. And when things go sideways, our basic human psychology gets cranked up to 11, often with, well, pretty disastrous results.
I'm talking about things like herd behavior. We've all felt it, right? It's like FOMO, the fear of missing out, but in reverse. When a panic starts and you see everybody else selling, that signal can be so powerful, so overwhelming, that you just throw your own research out the window and follow the crowd. It's this self-fulfilling prophecy, a cascade that just feeds on itself.
And then there's this other huge one, loss aversion. This is a game changer from behavioral finance. Basically, the researchers behind what's called prospect theory figured out that our brains are literally hardwired to feel the sting of a loss about twice as much as the pleasure of an equivalent gain. It's why that fear you feel during a market crash is so powerful, so gut-wrenching.
Put simply, losing $100 hurts way more than finding $100 feels good. And that simple, powerful idea, that is the psychological engine that drives panic selling. When you look at your account and see all that red, that intense pain just hijacks your brain. It makes you forget all about your long-term plan and hit the sell button at the absolute worst possible moment.
So what happens when you mix these two things together? You take highly leveraged institutions and you add a dose of panicked human psychology. Well, you get 2008, the global financial crisis, a complete meltdown that had absolutely devastating consequences in the real world.
Just look at the S&P 500. It dropped by a staggering 56.8%. Let that sink in. From the peak to the bottom, more than half of the market's value just vanished, wiped out. And this wasn't just numbers on a screen. The ripple effect was huge. In the year after Lehman Brothers went down, 6 million jobs in the U.S. disappeared. This wasn't some abstract Wall Street problem. No, this was a Main Street catastrophe, hitting real people and real families.
But here's the thing. As awful as these events are, they leave behind an invaluable playbook. If we're smart enough to study the wreckage, we can actually learn how to build something stronger, something more resilient for the future.
And some of the lessons are crystal clear. For one, things like regulation and deposit insurance, they work. They're like firewalls against that widespread panic. We also learned the hard way about shadow banks. These financial firms that act like banks, but don't have to play by the same safety rules. They can be a massive risk. And finally, it's not enough to just try and prevent a crisis. You absolutely have to have a plan for how to respond when one happens. The two have to go hand in hand.
Okay, so that's the big picture systemic stuff. But what about us? How do we take these lessons and apply them to our own finances? Let's get personal and talk about how you can start building your own financial armor to get through whatever the next storm might be.
Really, it all comes down to 4 key steps, or pillars if you will. And these aren't just about surviving a downturn. They're about building a rock-solid foundation for the long haul. It's about understanding your risk, making sure you have cash available, spreading your investments around, and, this is the big one, mastering that mental game we were just talking about.
And you can actually see this in the data. Look at what happened during the '08 crisis. Between 2007 and 2009, the percentage of people's wealth held in cash went up, while the amount in stocks went down. It's that classic flight to safety. It just goes to show you how incredibly important liquidity, basically having access to cash, is when things get shaky.
Which brings us right back to that 4th and final pillar, mastering your own mindset. Honestly, just being able to recognize these behavioral traps is half the battle. So when you feel that magnetic pull to follow the herd, or that gut punch of loss aversion, you can actually stop and say, aha, I know what this is. And that gives you the power to take a breath, step back, and stick with your plan, instead of letting your emotions run the show.
So, we've got the playbook. We know what to do on a big systemic level, and we know what to do for ourselves. But there's this one nagging question, isn't there? Have we forgotten all this stuff? Are we actually paying attention to the hard-won lessons of the past?
I mean, check this out. It's a really powerful analogy from economist Paul Krugman. Back in the 19th century, you had these things called wildcat banks. They were basically private banks that printed their own money, often with super shady backing. And guess what? They collapsed all the time. Now, fast forward to today. You have some crypto stablecoins being issued by secretive companies with, well, questionable assets backing them up. It's a crazy echo of an unstable past, a past we thought we were way beyond.
So in the end, the lessons of 2008 were written in the wreckage of a global recession. History gave us the playbook. It showed us exactly how things can break, and it gave us the principles to build them back stronger. The only real question left is, are we still listening? Do we as a society and as individuals have the discipline to actually follow the plan? And that's the thought I'll leave you with.